Right friends, welcome back to Banking Awareness. This is the 29th lecture. We are going to discuss special mention accounts, SMAs. What is the meaning of it? Central Repository of Information on Large Credits, CRILC. What do you understand by CRILC? What is the meaning of consortium of banks giving loans and multiple banking arrangements? What is the difference between consortium loans and multiple banking arrangements? What is the meaning of joint lenders forum when it is constituted? Then strategic debt restructuring. What do you understand by strategic debt restructuring? Then Basel norms. These things we are going to discuss in this module. First and the foremost is special mention accounts. All of you are well aware, once a bank has given the loan to some company, then what will happen? Company is required to pay back every month, which is popularly known as servicing of loan. Company has to service the loan every month, and if the loan account is not serviced for more than 90 days, that means if the borrower has not paid either the interest or the principal or both for more than 90 days, the account becomes non-performing asset. So, for more than 90 days, if principal or interest or both are not repaid back to the bank, then that account becomes non-performing asset. And Reserve Bank came up with this special mention accounts mechanism. Reserve Bank asked the banks, why do you wait for 90 days? Don't wait for 90 days. If the principal or interest payment not overdue for more than 30 days, that means up to 30 days, you classify it as SMA 0 or special mention account 0. Don't wait for 90 days. Once it crosses 90 days, that becomes a non-performing asset. Why do you wait for the loan account to become non-performing asset? Please act immediately. Don't wait for 90 days. That is the message given by Reserve Bank of India to the banks. Within first 30 days, when the loan account, that means principal or interest payment not overdue for more than 30 days, that is categorized as SMA 0 or special mention account 0. And next is SMA 1, that is principal or interest payment overdue between 31 to 60 days. Then SMA 2, that is a special mention account 2, that means principal or interest payment overdue between 61 to 90 days. That means before 90 days, bank has to categorize the loan account which is showing signs of distress, or you can say which is showing signs of default, as 3, that is SMA 0 during the first month, SMA 1 during the second month, third is SMA 2 during the third month, and don't wait till the loan account becomes NPA. That is the message given by Reserve Bank of India to banks through the mechanism of special mention accounts. Look into the next one, Central Repository of Information on Large Credits. Reserve Bank of India created one mechanism, that is the Central Repository of Information on Large Credit, popularly known as the CRILC. Banks should furnish credit information to CRILC of the borrowers having aggregate fund-based or non-fund-based exposure of rupees 5 crores and above once in a quarter. Once in 3 months, banks are required to give a list to CRILC for all the loan accounts of rupees 5 crores and above. That is the requirement, mandatory from bank's perspective. Second important point is banks should report SMA category also to CRILC once in 3 months. We have already discussed what is SMA category. Banks should report SMA category also to CRILC. And third important point is banks should report SMA 2 category to CRILC on 61st day itself. Just now we learned if the loan account is not serviced and the period 61 days to 90 days is categorized as SMA 2, and banks should report SMA 2 category account to CRILC on 61st day itself. This is basically with a view to monitor how many large accounts are there with the banks, and Reserve Bank of India will monitor through this how many loan accounts are there with 5 crores and above. Second important point is how many loan accounts have come to the category of SMA2. And here you may have a doubt, what is fund based or non-fund based exposure. Fund based exposure is when bank has directly given loan to the borrower, and non-fund based exposure is when bank has given letter of credit or performance guarantee to the borrower. If you want more about letter of credit and performance guarantee, please listen to my previous lectures. I have already deliberated on those two things in my previous lectures. Next is lending through consortium of banks. Frequently, everyone listens to this term consortium loans. What is the meaning of consortium loans? For big loans of 1000 crores, 2000 crores, 3000 crores, several banks will come together and finance a borrower. In this case, 4 banks, State Bank of India, Syndicate Bank, Punjab and Sind Bank, Canara Bank, came together with common appraisal, with common documentation, and with joint supervision, and with a view to have joint follow-up exercises. These 4 banks came together and gave loan to L&T. I have taken it as an example. So when several banks come together and with one documentation, common appraisal, and if it is granting big loan to some corporate company, that is known as consortium loan. Here in this case, 4 banks came together for granting loan to L&T, and here the bank which has given maximum loan normally will act as lead bank or convener. If State Bank of India has given more loan out of the total loan, then State Bank of India will act as lead bank or convener. So this is consortium of banks. There is another arrangement, that is multiple banking arrangement. In this case, 4 banks have given loans to L&T, but how this is different from consortium loan? Consortium loan, all the banks came together and with one documentation they have given loan to L&T. But in this case, these banks will act on individual capacity only. State Bank of India has given 1000 crores, Syndicate Bank has given 500 crores, Punjab and Sind Bank has given 300 crores. Like that, these banks are giving loans in individual capacity, and borrower avails loans independently from more than one bank. And second important point is, there is no contractual relationship between various bankers. In consortium loan, there is contractual relationship among the bankers. One bank will act as lead bank, but in this case there is no contractual relationship, and each banker will do his own credit assessment, and each banker will hold security independent of others. So these accounts where individual banks will give loan to single firm are known as multiple banking arrangements. One is a consortium of loan, when the banks coming together and giving loan as a group, and here multiple banking arrangement, banks will give loans in individual capacity. There is no group mechanism in this particular case. Look into the next one, joint lenders forum. For the loans granted by consortium lending as well as multiple banking arrangement, we have just now discussed what is consortium lending and what is multiple banking arrangement. For the loans granted to big borrowers through consortium lending or multiple banking arrangement, once the loan becomes SMA2, we have already discussed what is SMA2. For the loans granted under consortium loans or multiple banking arrangements, once the loan becomes SMA2 category, then joint lenders forum is to be constituted. As per the RBI guidelines for consortium loans, multiple banking arrangement loans, when the loan reaches SMA2 category, it is showing some default, it is showing signs of default. Under those circumstances, banks have to constitute joint lenders forum. Basically, joint lenders forum will look at the option of rectification or restructuring or recovery, whatever the case may be. That is, the main purpose of joint lenders forum is, let us not allow the loan to become NPA, because once it crosses 90 days, it becomes non-performing asset. Before that, let us constitute joint lenders forum so as to discuss with the borrower, so as not to allow the loan become NPA. That is the purpose of joint lenders forum. Right friends, next one, strategic debt restructuring. This is also applicable for consortium loans as well as multiple banking arrangements. The banks have given loans to big borrowers. We have already discussed it can be given in two ways, by become consortium or through multiple banking arrangements. Under these both cases, if the company failed to pay back, then this loan can be converted to equity. When company XXX has taken loan, that is known as debt. That debt can be converted to equity. That means these banks can assume ownership of the company. By converting that debt into equity, banks can assume ownership of company XXX if company XXX fail to pay back the loan. That is the meaning of this strategic debt restructuring. This was brought by Reserve Bank of India in the year 2015, and it gives ownership to the banks, and they can change the management. Banks can think of making turnaround of the company. So this is the meaning of strategic debt restructuring, and this is applicable for consortium loans as well as multiple banking arrangement lending. Last one is Basel norms. Before going into Basel norms, Bank for International Settlements. What is the meaning of Bank for International Settlements? It is the world's oldest international financial organization, and its headquarters are situated in Basel, Switzerland, and at the same time it has got two representative offices in Hong Kong. Hong Kong is SAR of China, Special Administrative Region of China, and at the same time Mexico. Two representative offices are there, and this Bank for International Settlements was established subject to the Hague Agreement. The Hague is in Netherlands, and this was established on 17th May 1930, and here 60 central banks or its members representing countries from around the world. Almost all the major economies' central banks are members of Bank for International Settlements, and these 60 central banks countries represent 95% of world GDP. And as I have already told you, head office is in Basel, Switzerland. You can say this Bank for International Settlements acts as a bank for central banks. All the central banks heads sit together at Basel to discuss the mechanism for promoting global monetary and financial stability. What is the mission exactly? The mission is promoting global monetary and financial stability through international cooperation. That is the mission of this Bank for International Settlements, and it is governed by the board of directors, and they elect chairman and vice chairman. At present, chairman is Jens Weidmann, and vice chairman is our Reserve Bank of India Governor Raghuram Rajan. With this backdrop, I would like to go ahead into Basel norms. This Bank for International Settlements established Basel Committee on Banking Supervision, popularly known as BCBS. What is the purpose of BCBS? BCBS main purpose is it will act as a forum for regular cooperation on banking supervision, or you can say it is to strengthen the regulation, supervision and various other practices of the banks worldwide so as to ensure financial stability. Stability of the banking system as a whole is very important. And with that view, this Basel Committee on Banking Supervision was constituted, and accordingly, based on its recommendations, various norms have been brought since 1988. For the first time, Basel I norms were brought in the year 1988. That is popularly known as Basel I norms. Basel I norms basically taken into account only credit risk. That means it has taken the risk of non-performing assets, or you can say when banks have given loans to borrowers, if they fail to pay back, that risk was taken care under Basel I, which is known as the credit risk. and it prescribed minimum requirement of 8% of capital. Capital adequacy ratio or capital to risk weighted assets ratio was kept at 8% under Basel I. What is the meaning of capital adequacy ratio? The meaning of capital adequacy ratio is how much capital is required if you compare it with risk weighted assets. What is assets in banking perspective? Assets means loans. What is risk weighted? They will be categorized based on risk. If bank is investing in government securities, the risk is less. It will be given certain index. And if bank is giving a loan to houses, that is home loans, the risk will be their slight risk. If bank is giving loans to corporate sector, risk will be high. If bank is giving loans in the category of personal loans, risk will be still high. Like that, various loans are categorized as risk-weighted assets, and by giving certain index to each and every loan, these will be calculated as risk-weighted assets or risk-weighted loans. And for 100 crores of risk-weighted loans, then if 8 crores are required, that is capital adequacy ratio or capital to risk weighted assets ratio. Under Basel I, it stated that 8% of capital adequacy or capital to risk weighted assets is required. Let me tell you once again, if 100 crores is the risk weighted assets, then 8 crores are required bank's own capital. That means 8 crores capital is required by the banks so as to give loans amounting to 100 crores of rupees if you calculate by giving some weightage to risk of each and every loan. Like that, Basel I devised just credit risk. But that was not sufficient. Subsequently, Basel II norms were brought taking into account 2 more risks. What are other 2 more risks? Market risk and operational risk. What is market risk? Market risk is the risk basically associated with some civil disturbance, some political disturbance in some country. These things are all market risks. And operational risk. What is operational risk? If there is some failure in the internal processes of the bank, if there is some failure in SBI itself, SBI there is some failure internally. So, the internal failures are categorized as operational risk. So, here Basel I credit risk was only taken. Under Basel II, this market risk and operational risk were also taken. Basel II was brought in 2004, but Basel II could not prevent 2008 financial crisis. Why? Basel II could not account for systemic risk. You may ask, what is systemic risk and what happened in 2008? In 2008, all of you are well aware, Lehman Brothers, that is the investment bank, in America 4th largest investment bank, Lehman Brothers collapsed. Why Lehman Brothers collapsed? Because of contagion effect. What is contagion effect? I will tell with one example. There lot of loans were given in America during 2005 to 2007 without assessing the credit appraisal, without looking at the repayment capacity of the borrower, and without assessing the real value of property. Several loans were granted in United States of America during 2005-2006, and that is known as the subprime loans. Why they are called subprime loans? Because of the reason the property values were not assessed properly, and it resulted in the collapse of economy in America. And not only giving these subprime loans, subsequently what happened? The firms which have given subprime loans have sold these loans to some other organization, and that organization has sold those loans to some other organization. Like that, contagion effect is there, and with that effect, entire financial system in some sphere failed in United States of America. The main reason for the collapse of Lehman Brothers in 2008 was subprime crisis and subsequent contagion effect. And so as to take care of such a systemic risk, Basel III norms were brought, and basically Basel III norms have to look at 3 things to improve banking sector's ability to absorb shocks arising from financial and economic stress. Second important point is to improve risk management and governance. Third one is to strengthen banks' transparency and disclosures. And Basel I norms were brought basically looking at credit risk. Basel II were brought after taking into account market risk and operational risk. And Basel III was brought subsequent to the subprime crisis and the collapse of Lehman Brothers in United States of America by taking into account this systemic risk. So, this is how these Basel norms were evolved over a period of time, and as per this Basel III norms, capital adequacy ratio in India, it was kept as 9% and to be ensured by March 2019. And I am not going into details of Tier 1 capital and Tier 2 capital because it is beyond the scope of this banking examinations. And look at the second one, that is leverage ratio, that is the Tier 1 capital to total exposure should be greater than or equal to 3%. And the third one is liquidity coverage ratio. Basically, liquidity coverage ratio looks at the requirement of money in the banking system for 30 days. What will happen if proper liquidity is not there with the banking system? Then it will lead to bank run. What is the meaning of bank run? Everyone will go and queue in front of a bank, that is a bank run. If liquidity is not ensured by the banking system, it will lead to bank run. So as to avoid such situation, this liquidity coverage ratio was mentioned, and this liquidity coverage ratio is the ratio of high quality liquid assets divided by total net liquidity outflows for 30 days. That means banks should require 30 days of liquidity under any circumstances. That is the meaning of liquidity coverage ratio. Last one is net stable funding ratio. Net stable funding ratio is the available amount of stable funding during the next 1 year. To take care of the requirements of 1 year, how much funding is required? And please don't forget, these four are the main stipulations. One is capital adequacy ratio, that is to take care of capital requirement when you look at risk weighted assets. Second is the leverage ratio, that shows the exposure of the bank. Third one is liquidity coverage ratio. Liquidity coverage ratio will take care of the requirement of money for the next 30 days so as to avoid bank run. Fourth one is net stable funding ratio, so as to maintain the banking system with the stability for 1 year, how much money is available. That is the meaning of net stable funding ratio. And more than that, one more thing is there for systemically important financial institutions. Recently, Reserve Bank of India declared State Bank of India as well as ICICI Bank as systemically important financial institutions, and for systemically important financial institutions, higher capital adequacy ratio is also devised. So, these are the stipulations of Basel III norms. Don't be frightened with this jargon of CET1 RWAs. Please understand the logic of this Basel III norms, right? So, with this, let us conclude the 29th module. Have a nice day. Thank you.